Hi, it's Andy Hoffman again, Media Director for Miles Franklin Precious Metals. It's Friday at midday, February 7th, in the aftermath of another hideous NFP employment report. And a lot to speak about today as we're getting ready for Janet Yellen to make her initial appearance on Capitol Hill on Tuesday. So let's start with the economic data of the week, which will end on the NFP report, of course. We started out earlier this week with the ISM manufacturing index plunging from 57 to 51.3, and the estimate was 56. Again, these diffusion indices I have little faith in at all. However, since they are so heavily manipulated, when you see it fall that much, most likely there's a lot of truth to it. Frankly, I'm not sure how it ever got to the 57 level in the first place. And it's really just joining what the rest of the world is seeing right now. As even in China, we're now seeing manufacturing and non-manufacturing indices sitting right near the contractionary level. In fact, China's PMI indices for both manufacturing and services hit their lowest levels ever this week, which were, one of them was 49.5, which is recessionary, and the other was just over 50. We also saw here in the States flat construction spending, factory orders down 1.5%, a trade deficit 10% above expectations, ominously, for the most part due to falling exports. The ADP employment report on Wednesday fell 26% sequentially from last month. The Challenger layoffs report, which came out on Wednesday, I believe as well, up 47% sequentially and 13% year over year. Of course, retail was the biggest reason for it, as the retail industry in this country is in free fall, and it is everywhere. And then we had the Bloomberg Consumer Comfort Index, which doesn't get a lot of press because it's not a government-issued release, but I spent a lot of time on it, and I wrote about it this week. It came in at minus 33, which was down another point and a half from last week. This index has been negative since the year 2000, if you could believe, which is, in my view, when society peaked, when the economy peaked, the dollar peaked, everything peaked. It had been fueled by the 1990s Fed money printing, which came after the PPT was created and Alan Greenspan came into office in 1987. But basically, that's when the whole thing started coming down, and it really wasn't until 2008 where the entire world realized just how bad things are, and the balance sheets of the sovereign nations exploded just as badly as those of the people within them. Anyway, the Bloomberg Consumer Comfort Index, by the way, it almost went positive at the peak in 2008. So that should show you that just how bad things were, that even at the quote best of 2007, 2008, it still wasn't enough to make people feel the wealth effect they had 8 years back, and now it's again decidedly negative and going nowhere. And then, of course, we had today's NFP report. 113,000 jobs created versus the consensus 181,000. The entire Wall Street was saying, well, last month was bad because of the weather, and therefore it had to rebound this month. Now, for one, there's a ton of evidence out there that shows there's absolutely zero correlation between the weather and job creation. And second of all, if you read the piece that we wrote 2 days ago here called Mother Nature's Had Enough, we show definitively that the weather this year was no worse than any other. In fact, the global temperature is near all-time highs. And November 2013 was the warmest ever month in the history of the planet, at least in the 125 years that they've been doing this data. What's more, in fact, plane cancellations have been down. Plane delays have been down. People missing work has been down over the last 5 years. The only thing that's down, which the mainstream media won't talk to you about, is the number of planes. The number of planes operating in the States alone is down almost 20% from 5 years ago. So when you see on the news the MSM say stuff like, well, there's big traveling over Christmas. Well, yeah, there's warm weather in the summer and there's traveling over Christmas, but it's down markedly from where it was years ago. And that's what the problem is. There was absolutely nothing that had to do with the weather in the jobs report in December, which, by the way, was not revised at all, and certainly not in January either. Then we go to the ECB, which had one of its meetings on Thursday. There was speculation they may lower their rate, which has been taken all the way down to 0.25%. They may lower it to 0, and announce that they may do some other measures like QE. They didn't, in fact, do that. They kept it at 0.25%, which is in and of itself as accommodative as can be. But if you listen to Mario Draghi, he was quite vehement in what he said. We will keep the rates low for an extended period of time. The risks are now clearly to the downside in the economy, and we will act swiftly with all available tools if needed, which clearly involve negative interest rates on deposits and QE. So trust me, it's coming. And then you have Japan, which reported record inflation last month. This was all this week when it was reported, not to mention the 19th straight monthly decline in nominal wages and a 16-year low in real wages. So this just shows you how well Abenomics is working with AB's all-time low approval rating as well. I wrote a piece this week called "The Japanese Noose is Tightening," and now you have the stock market in Japan falling as well. So will Japan be the first civilized nation, or so-called civilized nation, in hyperinflation? It's certainly a good bet. Back here in the States, I forgot to mention earnings this week. We had General Motors. Remember, this is their first quarter with no government ownership. Not that that's a good thing, having government ownership. But they're out on their own again. And as it turns out, they massively missed earnings, 25% below estimates. And the reason they gave? Bad sales across all regions. And the funny thing was that we had record channel stuffing for General Motors here in the States in the fourth quarter, meaning forcing their manufacturers, the factories, to build and stuff it down their dealers' throats. And in January, meaning after the fourth quarter ended, they had their second largest month of channel stuffing in the company's history. So if that doesn't tell you what's going on with the U.S. car industry, which, by the way, was the recipient of thousands of new subprime loans last year, I don't know what does. And of course, I have to mention Twitter, which has been one of the NASDAQ leaders in the past year, rocketing to ridiculous valuations in what I believe is the most useless technology ever created. I think it's a blight on society. Anyhow, it fell by an incredible 25% on Thursday when, actually its earnings were better than expected. It only lost $500 million. It was expected to lose more. But their growth in users, both in the States and around the world, basically came to a halt. There's almost no more growth in this business. So it shows you, this is what happens when you have a bubble and the Fed is printing money and the investors are throwing their money into garbage. Twitter, Facebook, you name it. And then we'll talk about the stock market, which until the last 2 days, when clearly there's been some major support from the yen carry trade, which I'll talk about in a second, and other reasons that I can't imagine, most likely the expectation of a pause in tapering. Until then, we've had a massive, massive plunge in the currencies around the world. I mean, here at Miles Franklin, we've predicted this for years. We predicted it in our year-end prediction article, and we've talked about it. I wrote the article last year called "The Most Important Article I've Ever Written," The Fragile Five, about how emerging market currencies are being destroyed by the export inflation from the Fed. The average currency in the world is down 30% in the last 2 years, and 10% in just since last summer. Because of the currency that was exported by the Fed. And, that's coincident with the start in late 2011 of Operation Twist and then QE3 and QE4. Anyway, I had to pause briefly. I'm back, so pardon me if it's a little disjointed. But as I was discussing, the currencies of the world continue to plummet. And eventually it will be the financial cancer will spread throughout the body, as I call it, and get to the head, which is the U.S. dollar, because there will be more money printing everywhere as the final currency war, as I call it, continues until the end game of the fiat currencies of the world. As for this yen carry trade, now I'm not going to go too deeply into it because even I have always had a little trouble with this. the concept of borrowing yen and then at no cost and putting it into other higher yielding assets. Yeah, I get that. It's some kind of a arb trade, even though it's not without risks. Of course, if you buy stocks or even low yielding bonds, there's risks. But now the algorithms have taken this whole yen carry trade to a whole new level, as we're now seeing an essentially 100% correlation between the Dow and the S&P 500 and the dollar-yen exchange rate, meaning whenever the yen falls, the Dow goes up. And frankly, you can read any of the pundits you want that say that somehow there should be a connection to this, but I don't buy it at all. I think these are algorithms trying to create a meme we know that Abenomics is going to destroy the yen, so they're trying to make it look like somehow this is good for the dollar. And if you want to believe that or for stocks, and if you want to believe that stocks are going to hyperinflate and make you millions, then that's great. But I advise you to take a look at what's happened to all the other stock markets that started hyperinflating, from the Zimbabwe's to the Weimar Germany's to today's Argentinas and Venezuela's. People are not making real money in them. And frankly, to believe that there's some correlation between the yen-dollar exchange rate and the stock market here is ridiculous. But keep in mind, just watch it, because you'll see, how the markets are unraveling, how the reality is unraveling on a daily basis. Of course, the reality of physical gold demand is another story. As it turns out, it looks like January will be China's all-time high in imports, in gold demand, physical gold demand. Remember, 2013 is going to have ended as double 2012's record level, and January of 2014 is going to be higher than any month in 2013. In fact, the high before this January, meaning last month, was April of 2013, which coincided, of course, with the what I call alternative currencies destruction, when they took gold down $250 and silver $5 an ounce in a 2-day period for no reason other than they were terrified that all their money printing was going to cause a surge in gold and silver. But when that happened, we had massive, massive demand, as I'm discussing here in China. And by the way, at Miles Franklin, we've been around 25 years. April of 2013 was the best month we ever had, 40% better than the second best month, which, by the way, was September 2011, when dollar price gold hit its all-time high. So to show you that this year, while gold prices have gone up a little and silver prices have gone up a little because the cartel is in there doing their shorting thing, we've seen an even bigger increase in physical gold since the year started. Heck, even the World Gold Council admitted this week, and I just wrote about it yesterday, that the all-in cost of gold is at least $1,200 an ounce, and that at least a third of all the production in the world will be unprofitable below $1,200 an ounce. Now, that's lower than what Nick Holland, the CEO of Goldfields, said in June of last year. Goldfields is the 4th largest gold mine in the world. He said it's closer to $1,500. But I think what the World Gold Council is referring to is simply the cost of production and maintaining reserves, whereas Nick Holland is saying sustainability, meaning the ability to replenish reserves, you need much higher prices. So either way, the price, I called my article yesterday, that other reason to own gold. Again, put on your investment hats. Even though gold and silver are money, not an investment, the fact is at these prices, you're not going to see production. It's going to fall off the map, and the same with silver. Both metals, in my opinion, are well below the cost of production. And therefore, whether you believe in the monetary story or not, you're buying at dirt cheap levels from a simple commodity standpoint. Anyway, two final things. One, I wanted to note that last night, I'm making fun of Twitter here for being useless, but last night, incredibly, I almost thought this was a joke. Blythe Masters, the head of JP Morgan's commodities division, who's been caught in every possible controversy imaginable, to put it mildly, accepted a position on the CFTC's advisory board. You talk about the fox being asked to guard the hen house. And amazingly, just this morning, she canceled. She withdrew her nomination because of Twitter. There were thousands of tweets that were angry that this was going to happen. So good for Twitter. You do have some use out in the world. And then last but not least, And pardon that pause, I had a little glitch here. Tuesday morning is all important. That's when Janet Yellen's semi-annual former Humphrey Hawkins testimony to Congress is given. She'll have some prepared remarks Tuesday morning, and then she'll speak Tuesday to the House and Thursday to the Senate about her plans. Now remember, the Fed never makes policy changes at these meetings. They simply just, say this is what we're doing, this is what we have been doing. They try to get through it without making any waves. 2 years ago, the cartel initiated the leap day violation when Bernanke spoke. He said absolutely nothing. Last year, when Bernanke spoke, gold surged higher, which is what made them attack a month later in April. So the fact is, I wouldn't get too excited about it. She's under a lot of pressure because of all this horrible economic data to untaper, but she's going to try to do it as carefully as she can. The markets are eventually going to force her hand, whether she gets what she wants or not, because ultimately she's going to have to increase the amount of money printing if she wants to prevent these currencies from immediately collapsing, and for that matter, the Dow Jones propaganda average. So anyway, I hope you have a good weekend, and I really hope you're thinking about preserving your financial wealth for what's coming going forward, because by hook or crook, the money printing is going to get out of control in probably the next 12 to 18 months, and at some point, so are the abilities of the powers that be to control the markets and the fear. That being said, have a great weekend.